Is Canada stepping into a golden era of investing in seniors housing? With the senior population projected to reach 5.3 million in the next decade, increasing by 1.7 million, the question looms large for investors eyeing opportunities in multifamily real estate. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Back in 2021, Harrison Street Asset Management was among the few investors willing to venture into seniors housing despite the pandemic's challenges. Demand was low, operational costs were soaring, and the vulnerability of residents to COVID-19 led to declining occupancy rates. However, as Canada emerged from the pandemic, the landscape began to change dramatically. According to Tegan Sliz's report, the silver tsunami is creating a perfect storm for investors with occupancy rates rising and costs declining. Jonathan Turnbull, managing director and head of Canada at Harrison Street, noted a significant rebound in interest post-pandemic. "We've seen a substantial rebound in interest post-COVID," Turnbull shared with Stories. He emphasized the demographic trends driving this interest, pointing out that Canada's senior population is expected to grow at an average of 4% annually over the next 20 years. This demographic boost, combined with a lack of supply, is creating a compelling investment opportunity. The Cushman Wakefield Seniors Housing Report indicates that 2025 could be a record-setting year for seniors housing deals. New construction starts have been sluggish, dropping below 1% of total inventory in 2023 and 2024, with forecasts predicting slow growth until 2030. This creates a significant supply-demand imbalance that investors are keen to exploit. Stephen Hiscox, Executive Vice President of Seniors Housing and Healthcare Group at CBRE, describes this period as a golden era for seniors housing investment. "The boomers are going to be the golden era," he said, highlighting the generational shift and the inevitable demand that will follow as boomers reach their 80s. Furthermore, much of the existing seniors housing stock is aging and in need of replacement, further fueling demand for new developments. While demand is high, development has faced hurdles due to increased construction costs and limited land availability in high-density areas. Hiscox points out that construction costs have risen significantly, making it challenging to build new facilities. Additionally, land suitable for seniors housing is often zoned for large residential projects by condo and multifamily developers, creating delays in development. Despite these challenges, interest in building is growing as condo developers seek partnerships with seniors housing operators. Chartwell, Canada's largest seniors housing operator, has been actively expanding its portfolio, acquiring multiple properties in Ontario and Quebec this year. These strategic moves highlight the growing interest and potential profitability in the seniors housing market. Another positive development is the stabilization of operating costs. During the pandemic, competition for registered nurses drove up labor costs, but this has since subsided, bringing costs back under control. People feel like they're getting control of their costs for the first time since the pandemic, Turnbull noted. This newfound stability is encouraging investors to re-enter the market with confidence. Moreover, there's a generational shift in attitudes towards retirement living. Boomers, having witnessed their parents' experiences, view modern seniors' residences more favorably. These facilities now offer amenities and a lifestyle that appeals to this generation's preferences, making them more attractive options for retirement living. Both Turnbull and Hiscox caution that choosing the right operator is crucial for success in this market. The experience and care provided to residents are key to the long-term success of any seniors housing investment. Nonetheless, the market fundamentals remain strong, with demographic trends and low supply creating favorable conditions for investors willing to navigate the challenges. Turning our attention to a significant development opportunity at the intersection of Toronto and Markham, a prime site has been listed for sale with approvals for a high-density residential project. This site, represented by Jeremiah Seamus and Matthew Soper of Private Capital Investment Group at Colliers, offers developers a chance to capitalize on a burgeoning area with a transit-oriented development. The site covers 2.3 acres and has received approvals for two towers of 40 and 44 stories, delivering a total of 1,060 residential units. This is a marked increase from the initial plans filed back in 2019, which envisioned a more modest development of 27 and 6 stories with 533 units. Located at 36 to 48 Steeles Avenue East and 37 to 49 Highland Park Boulevard, the site is currently occupied by 14 single-family homes, which are slated for demolition. The site's strategic location is bounded by major thoroughfares such as Steeles Avenue and Dudley Avenue, providing excellent connectivity to transit options, including the planned Yonge North Subway extension. The area is well serviced by high-frequency bus routes and is in proximity to highways 407, 404, and 401, making it an ideal spot for residential development. The development has been approved by the Ontario Land Tribunal as of May 2024, allowing for a total gross floor area of 858,648 square feet and a floor space index of 8.27. Plans include 510 vehicle parking spaces, 740 bicycle parking spaces, a public park, and a privately owned publicly accessible space. Furthermore, there's potential for an additional 23-story rental tower, which could add 250 units and 180,000 square feet of gross floor area, pending further approvals. From an investment perspective, this site presents a robust opportunity. The surrounding neighborhood boasts a high-income, well-educated working-age population with an employment rate exceeding 90%. The vicinity offers a variety of amenities, including the Centerpoint Mall, numerous restaurants, parks, and schools, enhancing its appeal for prospective residents. With the neighborhood undergoing significant transformation, developers have the opportunity to deliver much-needed residential units and contribute to the area's growth. In recent developments, Willow Bridge Property Companies has unveiled a new multifamily property called The Park at Katy Trail in Dallas. This 300-unit complex is strategically located at the intersection of Carlisle and Bowen Streets. The units vary in size from 756 to 1,682 square feet, providing a range of options for potential residents. The property boasts luxurious amenities, including a tanning shelf, equipped with in-water loungers and poolside cabanas, adding a touch of resort-style living. Jeff Courtwright, president of Willow Bridge, expressed his long-standing belief in the site's potential, stating, "We've long believed this site had the potential to become something truly special. This development represents a significant milestone for Willow Bridge as they expand their footprint in the multifamily sector." Meanwhile, CAP Multifamily has launched Beacon Rail District, an 18-unit boutique property located in Frisco, marking the first residential apartment community in the city's historic downtown. Lease rates for these 1- and 2-bedroom units range from $1,950 to $3,800, and the property is set to welcome its first residents in mid-September. Shifting focus to the leasing market, Terraces at Solana in Westlake has attracted 3 new tenants, including defense contractor M1 Support Services, Century 21 Mike Bowman real estate firm, and technology workforce development company Pluralsight. This influx of leases has brought the 8-building office development to 80% occupancy, a promising sign for the commercial real estate sector. On the sales front, a notable transaction occurred in the Barnett Shale sector of Denton County, where a 661 net royalty acre mineral package was sold to an undisclosed buyer. This sale, facilitated by BKV Barnett and Dallas-based Rising Phoenix Capital, highlights ongoing interest and opportunity in areas outside the traditional hotspots like the Permian Basin. In the multifamily arena, Mason plus Mill, a 349-unit property in Mansfield, has changed hands with Milburn & Co. acquiring it from the previous owner. This deal, brokered by institutional property advisors, underscores the robust activity in the multifamily market as investors seek stable returns amidst economic fluctuations. Lastly, Franklin Street, a Tampa-based commercial real estate services firm, has entered the Dallas market, appointing Chibuzor Naji as managing director to lead their multifamily investment sales team. This move signifies Franklin Street's commitment to expanding its presence and influence in the Dallas commercial real estate landscape. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.